No, yeah, work's been busy. Healthcare is exploding, especially healthcare in AI and healthcare.
Why didn't you get? Why did you chose not to buy a house?
Market looks crazy, especially when you look at New Mexico. New Mexico, there's some houses that Lauren and I were looking at. Those houses that were sitting around, that you can find easily in that are maybe 190, 200, 220, 230. Here in Las Cruces, now they moved up to 300, 330. Housing market's pretty crazy right now. So we decided just to be able to rent. We obviously don't know where we're going to be at. If we're going to be in Arizona a year from now, right? Or if we're going to be in
Right.
Colorado a year from now. So, or if
And
we're
you
going to be
just
here.
you
So
just moved in, huh?
we left our options open.
You
As
just moved in the house. You just moved in.
I'm going 3 weeks strong right now. So,
Okay. Okay.
3 weeks strong.
Just had a baby. Just had a kid. You just had a kid too, right? You just had a baby.
August. You're not an uncle yet. You got to
Oh,
get a couple
dang.
more months.
Right. Yeah. Not yet. Okay. So, anyways, hey, we're on this live right now, YouTube broadcasting. We're gonna go through this macro report. The question is, what the hell is going on in the market, right? A lot of people may be confused. Should I invest? Should I not invest? You're hearing people say, you know, it's a recession. Be in money market funds. We have a lot to talk about when it comes to that. But the market is on fire and nobody can believe it. Huge short squeeze happening as we speak. So we're going to go through this macro report. And what it is macroeconomics. So, what's actually happening in the economy, what's going on with the Federal Reserve, inflation, how, the market is responding to that exactly. The biggest thing is really inflation right now. And that's what we're going to go through. My brother's here, Josiah, right there at Mind Growth. That's Josiah, my younger brother. I'm Jay Fielder. Find me on TikTok. Got a pretty good channel on TikTok. I'm on YouTube. Got to get the subscribers up. So you guys subscribe if you're new. If you're in here, check out the videos. We're gonna start doing these live streams though, and also post it as a video to inform you what's going on in the market, just to get a little better, a little more information out there because some people don't like to read. So I'm gonna read it to you. We're gonna go through it. And so far we've been right. Sorry to be cocky, but we've been right. We said the bottom was in October, right? The bottom was in, maybe it was November. We said the bottom was in, the market was going higher, and there's a lot of reasons for that. So let's jump into it. Let's jump into it. Okay, we'll finish there. So basically, go ahead. Did you have a question?
Yo, let's start off. We've been talking about inflation over the last couple of weeks. You let me know inflation is done. Inflation is done. And let me know, tell me why. Let's talk about that.
Inflation is done. Inflation is done, right? And we're going to get to that. I'm going to tell you exactly why inflation is done. But if it wasn't, do you think, okay, if inflation wasn't done, do you really think NVIDIA, Microsoft, these are trillion-dollar companies, NVIDIA, Microsoft, Apple, right? Pretty clear there. Do you think they would be making all-time highs? Do you think the smartest people in the financial sector, the smartest people in the world that are, that are billionaires, quadrillion, no, I'm just kidding. That's not a thing, quad millionaires. But the smartest people in the world are buying these companies for a reason. They're making all-time highs. Apple's at near $3 trillion now. And there's a reason for that. These are called mega caps. And the reason, and some of you guys probably know that, but the reason they're going higher is because the biggest force, the biggest negative force, the biggest, we like to say, headwind in the market has been inflation, right? And that is pretty much done. Even though prices are still elevated, inflation is not, oh my gosh, prices are still elevated. No, it's the rate of change. It's how fast something is going up. And that's pretty much done. So we're seeing a short squeeze. Now, this is a little complicated here, so ask me questions. But a couple weeks ago, I said, I think it was about 3 weeks ago, I said, if we get over 4,200 in the stock market, so if the stock market, can you guys see this really quick? Yeah, you can see it. So if the stock market gets over this 4,200 level, and this is SPY, this is the level right here. Pretty sure it's clear. Let me double check. We get over this 4,200 level, there's going to be a short squeeze. Why is that? Why is there going to be a short squeeze? What the hell is a short squeeze? You're supposed to be asking me, what is a short squeeze? A short squeeze is basically everybody betting against the stock market because they believe inflation's here, the war is going to get worse, there's going to be economic collapse. Everybody betting against that is either invested in cash, holding cash. They're scared to invest, or they are shorting the market. They're betting against the market. And now that, this right here is basically, it's really, non-commercial net E-minis S&P foots. What it really means is this is a record high. So if you see at the bottom here, we haven't been at this level since 2007. What happened in 2007? Do you remember? I mean, I know you're young. How old were you in 2007?
2007, I was 8 years old. So let's talk about
that. You don't remember that crap because 8 years old, you really didn't care. You're
playing. Investing at 8 years old.
Yeah.
So what happened in what's happened now that also occurred in 2007?
Well, people are afraid. Well, 2007 was right before the GFC, which is the Great Financial Crisis. That was the biggest crash, really. It rocked the whole world. A lot of people committed suicide. A lot of people lost their homes, and a lot of people went broke. The stock market dropped 50%, and that was terrible. So and what this really marks is, people were negatively positioned against the stock market. They were betting against it. So we had that. We actually beat that record here on the right. We actually beat that. There was more people negative betting against the stock market because of inflation, because of the recession, because of the Fed hiking rates. We'll get to that soon. And now that line is moving up, what that is the relief of pressure. It's actually people getting out of the market. So if you're an investor, just realize, now it's not over yet. Maybe it comes back down. I doubt it. What's happening here is all the negative bets are having to cover their positions. If you were long Apple stock and it dropped too much and you sold your position, then you're selling your position, you're getting out. And this is the opposite. These are people selling positions. It's really complicated. And in order to not lose money, they have to buy back their positions. And that is a short squeeze. That's what I've been talking about. We're seeing the short squeeze. It's moving up. I expect this line to start skyrocketing back to zero, maybe within the next year. We'll see how it plays out. So the short squeeze continues. And the real issue here is that inflation is done. So I'm sure inflation is affecting a lot of people. I know you said that housing is expensive. You don't want to buy a house. It's tough because we got us people who already have a house that are locked in the rates. They're doing pretty well. But if you're not locked in, then it's expensive, right? Rates are too high. The prices exploded because of all the money printing. But I'm here to tell you guys that that inflation is rolling over. Now, yes, your items are going to be more expensive. Services are still kind of hot. But as an investor, the stock market is now pricing out inflation issues or inflation risks, and it is now pricing in the downside. It's pricing in the end of the worst thing you can see. We haven't seen this for 40 years. So
tell me a little about this chart. You have energy energy looks like to be the high here. What does this chart tell us?
So this is the majority of inflation pressures right now, like currently. So these are all, going throughout the year. You see which color do you see is the largest portion, right? These are all month to month. Which color?
We're looking at our services with food and energy.
Yeah, services. Oh, my bad. Services X food and energy. What that means is services are the largest portion of inflation. And that's X food and energy just means you're stripping out food because it's volatile. You're stripping out energy, which is natural gas, oil. You're stripping that out and you're just focusing on services X food, or excluding food, excluding energy. That is the real issue here. The rest of everything else, like goods is basically flat. Goods is disappearing. You see it just, shrinking. The goods inflation is shrinking. That's great. Energy is negative. So below this line, that's negative. Energy is going negative. Gas prices are falling in some areas and falling in others, but the expectation for energy is going lower. And it's really about this services. So just keep that in mind first. Services are the thing that need to go lower. And it looks like it's still expanded. So why would the stock market be so hot? Why would it be exploding? Like going back to that chart, we saw this huge move to the upside, right? This was a big move for the S&P 500. It's been going straight up. We are up now from the lows. Well, this isn't even the lows. We're up 16%. We're up 20% from the lows. So the stock market, right? This is a big market. From the lows in October, we're up 20. Holy crap. We're up 27%. You don't really see that in a bear market. Like this was the uptrend and it just exploded through the uptrend. It got above that level. And you have to wonder, well, if things are so bad, if inflation's so bad, if services are still elevated, why is the stock market moving higher? Okay. Now, another word for services is core CPI. So essentially, you have headline CPI, you have headline inflation, and that those are usually the numbers like you turn on the TV and you see, oh my God, inflation's at 6%. That's just the headline numbers. But there's a lot of other inflation measurements that the Fed focuses on, economists, investors focus on, and the real issue right now is that services. Another word for that is core CPI. So we call that core CPI. Core CPI, just remember, is another way of saying services inflation, right? So now we break down the services X food, X energy. When we break that down, this is the breakdown of that. So now this goes into smaller tiers, right? So like if you were to take a pizza apart, you cut a pepperoni pizza down. Now you're looking at one piece of that pizza. Now you're looking into now what's on that pizza, right? Do you have olives? Do you have pepperonis? So you're looking micro now. You're how do I say this? You're dialing in on what are the services that are actually putting pressure on the economy. So as you can see, what is the biggest color you see here?
We see, let's look at shelter. Obviously,
Shelter.
this seems to be the one that
Shelter.
appears the
Right.
most.
And that's housing prices. That's basically housing prices. And shelter is the biggest component basically of inflation. And what I basically wrote up here is that yes, shelter is the word sticky, because sticky is what everybody's afraid of. Is that inflation will stick around longer than expected? Okay, so looking at the blue, what is that? Transportation. That inflation is basically, it's not really important. It's pretty much done. Transportation goods in yellow, that's pretty much done. Housing supplies is pretty much done. You see it. So it's all shelter. It's basically shelter. The thing about shelter that people don't understand is that the shelter measurement, so this measurement right here from the Fed, is a lagging indicator, which means you're looking backwards. It's almost like you're in a car and you're looking backwards to look forward. If you're driving a car and you want to know what's coming next as an investor, as a driver, okay, that's kind of confusing. But if you're driving a car, right, and that's kind of the economy, where are we headed next? Are you going to when you look at the road, that's data that you're reading, right? Are you going to look backwards to see where you're headed, or are you going to look forward?
If you're driving, I would hope you're looking forward.
You'd hope you're looking forward.
So question there. In this, you mentioned that a lot of investors may be looking back. They're looking at past trends to see where the future is where those patterns are going to take us in the future. Explain how we should be looking moving forward.
Well, the investors are looking forward, which is why the market is exploding. And this measurement right here this measurement is a lagging indicator. So shelter is lagging by 6 to 12 months. And just think about it. If you're going to the gas station, right, that's like real-time inflation. It's happening in real time. You go to the gas station, the prices move every day, right? They pretty much move every day. So you get to see the changes in that percentage versus shelter. If you're renting, your rent doesn't change week after week or day after day or month over month. It's right. Every 6 to 12 months. That's why it's lagging, because you sign a contract, and when you sign a contract, that price stays there. Even though inflation might be falling, housing prices might be falling, the actual contracts are still kind of sticky. So we are looking backwards on that. So that's one thing. Now in real time, right? This is the Fed's inflation indicator, CPI. In real time, you have Zillow, Redfin. This is the real-time data, and those are actually collapsing. So the real-time rent data is actually falling apart, but we keep using this for the headline number. And I think the market is now sniffing that out. The market is basically saying, and let's go to do I have Apple on here? Look at Tesla. Like Tesla is ripping. I guess it doesn't look that great. Nvidia is a little better, right? Nvidia is the AI stock. Nvidia is making all-time highs. We kind of talked about this. It exploded. So it's sniffing out that, you know what, inflation is not really an issue because this is lagging. The real-time data is actually much lower. And that's where we're headed next on this chart, or on this report, is basically shelter CPI in orange is at 8%. But like we said, that's looking backwards. So the Zillow rents, this is Zillow versus the CPI, the Fed CPI. The Zillow rents, you can see they rolled over back in September. So this rollover happened back in September, and it's been pointing straight down. Now, if it's leading shelter by 6 to 12 months, what do you think is going to happen to shelter CPI?
Sorry.
Right? If Zillow rent leads shelter CPI, so if this indicator is a leading indicator for this one, this rolled over, right?
Yeah.
Zillow rents real time rolled over. So 12 months later, you should see shelter CPI pretty much roll over, right? And that's what we're seeing now. It's starting to flatten out. You see it starting to flatten out there, and it's rolling over. So that's really the concept. That's really the concept that we're looking at. You can look at other, other people say, "Oh my gosh, well, there's other inflation happening." And one thing to remember, like the inflation battle it's not really just inflation that people are worried about. It's also the Fed hiking rates or making it more expensive for to borrow money, making it more expensive to borrow. So if you're trying to buy a house, like the Fed isn't literally directly tied to how much you pay for a house, but it's a trickle effect. So if you're trying to buy a house and the Fed keeps increasing rates, then that trickles into 30-year mortgages, 15-year mortgages, and you're going to be paying more. So you're afraid to buy, which kills growth, right? It knocks growth down. And what we're seeing now is that the idea is that the Fed just wants to get inflation numbers below the Fed funds rate. This is called restrictive territory. And right now, the Fed funds rate here is at 5 to 5. There's 3 rates, but it's basically from 5 to 5.25. That's where the rates are at. And man, I hope we're not lagging here. That's where the rates are at. So now we're seeing inflation below that. So we are now in restrictive territory, which means that that the Fed can ease off the brakes and not really tighten more because things will break. And you asked me about the banking crisis. I know back then that was basically a result of the Fed increasing rates. Is banks started losing money or started breaking down because they lend short and they borrow short and they lend long. So that's a little more complicated, but basically the increasing of rates killed their margins, killed their profitability. So they had to sell treasuries, they had to sell assets at a loss. And then plus people were leaving the banking sector, they're leaving the banking sector so that they could go to money market funds and collect 5%, because your bank deposits are giving you like 1% or less than that. So they lost all their collateral to actually lend out, which crushed the banks. So now everybody's getting excited because they're saying, look, all these inflation indicators are falling now, right? With the exception of shelter being a little more sticky, but it's not really sticky. And so, now that we're lower, well, the dragon is done. The inflation dragon is pretty much headed lower. The trend goes lower. If it was moving sideways, maybe it'd be a little worse, but it's moving lower. And these are real-time prices right here, like export and import prices. The cost of trade. This is the cost of trade. Everything's about cost, right? The cost of exporting goods and services, the cost of importing, they're negative. So these are actually negative, which tells you inflation pressure. We're actually headed for deflation, which is the opposite. And if we go deflation, then there's one thing that the economy or the Fed's going to have to do, which is to re-stimulate the entire market. Right?
Let's back up a little bit there. Explain why these prices are negative. Why the export prices, the import producer, why these are all negative.
Well, so one of the reasons they were elevated in the first place was because during COVID. So inflation works 2 ways. Inflation goes higher because more people are buying items, right? So if you're increasing the demand, then people are going to increase their prices because they're not going to make the same amount they only have so many items, and if they can, they're going to raise prices basically. But the other side, the worst side, because the really side that really crushed us was the supply side, which is actually producing services or producing goods. So when you take workers away or you eliminate the production of anything, then prices automatically go higher, because in order for you to meet, if you're running a business, let's say you're in a lemonade stand, in order for you to meet your normal revenue of $100 a week, maybe you're making $100 a week, but all of a sudden you have less lemonade, right? And that $100 is coming from this isn't realistic, but 10 cups of lemonade. So you can only buy 10 cups of lemonade. That's how much you get each week to sell, and you make $100. But what happens when there's not enough supply and you can only sell 5 cups of lemonade? What are you going to do? You're going to sit there and say, well, I'm going to take a 50% cut. I'm going to just make $50, even though I'm still paying rent, right? $100 in rent. So I'm going to take a cut. No, what they're going to do is they're going to double the price on the cup of lemonade because they have less supply. If they can, they're going to double that price, and they're going to make their $100 again. So what happened is up here, we spiked because there was no supply, right? Nobody was producing. Like China got shut down. Everybody was shut down. So you couldn't really move items across the earth. across the earth, across the ocean. Do you remember California? They shut down their ports and everything was backed up. So that was the result of that. You got a spike because the supply was shut down, plus people were ordering like crazy. Now, as soon as we opened up back in the US, now the rate of change of inflation when it came to importing and exporting basically rolled over because you had people working again. So you could lower your prices. There was more deliveries. Delivery times came down. Orders were pushed through. You didn't have to wait on your order. So more demand was the same, but now you had more workers come into the economy. So it is kind of like, it's hard to understand fully, but the base is like you have more supply coming into the market. And anytime you increase the supply of anything while the demand stays the same, the price of it usually drops. So that's kind of that. I don't know if that fully makes sense.
Sure.
It's kind of complicated.
Yeah.
Now the next part, this is all about inflation being done, because this is why the market is ripping. All the inflation indicators we went over are falling except for shelter. But like we said, shelter is actually decelerating in real time, and everything else is pretty much falling. So PPI is producer prices. Now these are what producers or manufacturers are gonna pay to actually run their business. And these have been dropping for 11 months. So we'll just go through this. We've been dropping for 11 months. Okay, core, you go to the core, minus food, minus energy. That's what core means. Those are also dropping below Fed funds. And the Fed's target is really 2%. And I don't know if you can really believe them, but either way, their target is 2%. And we're seeing, progress being made towards that front. Now, another reason the market is going higher is because not only is inflation coming down, but it causes the Fed to stop hiking. Oh shoot, what is that? Got a little echo. Where did that come from?
Is it still going?
No, I don't hear it no more.
There shouldn't be an echo, no?
Okay, it was a small echo. I don't know. Okay. I wonder if we're lagging. Isaiah. Anyways, we got a couple eyes on there. What up? Shout out to the chat. Right. We're talking about inflation here. Oh my bad. Talk about inflation here, why it's coming down. So the Fed can now pause because, like we said, all this inflation is coming lower, right? The inflation is coming lower. That's the main dragon that we've been trying to actually slay, was inflation, and now it's actually starting to subside, even though people say it's going to be sticky. But their only argument is that core, that housing stays elevated, but we know in real time that's not happening. The second part is the Fed's going to have to stop because jobless claims just broke out. Jobless claims is a reflection of people filing for unemployment. And last month we saw the unemployment rate finally, start to move up a little bit, move from 3.4 to 3.7. And usually the Fed will cut rates or they'll stop hiking if it moves up by 0.5%. So from 3.4 last week to 3.7, we're almost there. 3.9 would mean historically that they got to cut rates. Doesn't mean they're going to do it. Either way, this is putting pressure on the Fed to actually cut because more people are losing their jobs. So their mandate is to get inflation down, not necessarily unemployment go higher, but they have anticipated that unemployment will move up to 4%. And the market is moving. You would think that that's negative for the market. You would think, okay, we're going lower. That's not good because people are losing their jobs. But the market is very forward looking. It looks into the future. And what it's seeing is, okay, the Fed might actually have to cut rates. And if you bring the cost of capital lower, because people are losing their jobs and you have to re-stimulate growth, if you bring the cost of capital lower, which is cutting rates, then the market is going to get bullish off that because it means it's cheaper to fund your growth. The real threat would be a collapse in growth completely. But we're just not seeing that. And there's a lot of reasons we are not seeing that. Part of that is the Inflation Reduction Act. Some of the stimulus from Joe Biden. Joe Biden, basically the infrastructure bill, it was $1 trillion of stimulus into the economy. This is why we're not really getting a real collapse yet, because the infrastructure bill was $1 trillion. The Inflation Reduction Act for renewable energies, right? EVs, all that stuff. That was like 400, I think I got it up here, $650 billion. And then the CHIPS Act was $280 billion. So that is working its way through the economy, which means it's going to, growth is going to stick around a little stronger than expected. And so the market has seen that as super bullish because inflation's coming down at the same time. growth is sticking around. It's not falling apart. And typically, when you do bring inflation down, the economy collapses. But we're not seeing that yet.
Okay, awesome. Well, it looks like we got our first question in the comment section. Is crypto not moving due to regulatory pressures?
Is crypto not moving due to regulatory pressures? Yeah, I would say so. I would say that crypto definitely, and we're going to get to crypto. It is down here. Crypto is not moving because, well, it is. I would say it's not. It kind of front ran the market. So crypto moved up before the stock market did. Back in September, October, Bitcoin bottomed a little before the actual stock market did. And so I think it's just taking a break. And a lot of it is obviously Binance, the regulation. But we did get some news today. I think the SEC is making a deal with Binance about moving the accounts back to the US, something like that. There's some regulatory pressures, though, that are definitely going on. And now that the SEC is taking care of that, crypto is going to go higher. It's just going to take some time for that to filter through. But the big case for crypto, outside of the regulatory pressures, like why would people buy into crypto? Why is it going to go higher? Is global liquidity is one of those big things. In China, they're actually dropping rates. So as we're increasing rates or holding them, China is the second biggest economy on earth. And being the second biggest economy on earth, obviously, if they ease their economy, if they drop rates, they drop these short-term rates, these one-year lending rates, they're essentially increasing cash flow into their economy. And that's going to trickle into assets, whether it's, equities or crypto or whatever it is. So China's cutting rates, basically. They're going to start cutting rates a little further, maybe not aggressively, but they are cutting rates. And then at the same time, you have Japan increasing their bank lending. So as they increase bank lending, that's more liquidity. That's the third largest economy on earth, right? So you have that happening. And if you have the second and third economy stimulating their markets or their economies while the US is starting to pivot, right? We're starting to turn around and no longer increase rates. And actually, we're seeing, progress on inflation. If we're seeing that, then that's going to make a strong case for risk assets to move higher. Thus we see, NASDAQ, we see, where's NASDAQ? You see NVIDIA going higher. You see here it is, the NASDAQ exploding. So this is the technology sector and everybody expects it to roll over, but it just keeps going higher. It just keeps moving up. And that's just a reflection of the actual macro conditions starting to improve. And that's what this next chart is the macro forces, which is bond yields, the cost of capital. And you got bond yields. You have, let me see if I can put that in view. You have bond yields right here. This is the cost of capital. And then you have the dollar, you have crude oil, and then you have volatility, or the VIX. You remember the VIX, right? People would be buying the VIX thinking the market's going to go lower. So the VIX exploded during COVID because it was risk off, right? It was risk off. And when you take risk off the table, then this thing goes higher. This volatility goes up because it's basically insurance against the stock market. But the fact that it's making, lower lows over time, it's actually at a 3-year low. So we haven't seen the VIX this low since 2020, I think. I think it was like February of 2020. So it's sort of signaling that, hey, investors are more confident in the stock market. They're not betting against the VIX. They're not buying insurance. And insurance is for risk. So if you're not buying insurance, then you're expecting risks to be, resolved. And that's part of that. Now, crude oil coming lower. The reason I have these 3 arrows, because these are my macro forces. And crude oil coming up, this is the biggest input to inflation, is really the cost of energy. So CPI, right, puts energy into, you see energy is inside of CPI, but the Fed doesn't measure energy because it's a large component. Well, for core, they don't measure energy all the time because it's a large component and it's volatile. It moves up very fast every single day, whatever. But my case is, the lower energy goes, the lower crude oil goes, the lower gas prices, the lower energy costs. And if it breaks even lower, if it finally breaks down, then you're going to see real-time inflation break even lower, and investors are going to get even more hyped up because one of the reasons investors have, because there's a record cash on the sideline, right? A lot of people are holding a lot of cash. We see money market funds at $2 trillion. I'm sorry, $5.3 trillion money market funds. And so we're making an all-time high in people stacking cash. And that's kind of like gunpowder, right? It's kind of like gunpowder. You're loading up you're loading up the boat with gunpowder, or not the boat, you're loading up some bomb, and the bomb really is, well, what explodes is the market, and we are starting to see that. So that's taking pressure off inflation expectations for the future. And then the dollar is the other part. The dollar moving lower is always correlated with the market breaking out. So those three are moving lower. The only negative we have right now is really bond yields. Bond yields is the cost of capital, and this is moving higher just because the shelter costs are still kind of elevated. So what happens here is bonds move according to growth and inflation. If inflation is high, bond yields move up. And bond yields are the cost of capital. It's the cost of borrowing money. So money gets more expensive if inflation goes up. And we're really waiting for it to fall, but it just hasn't done it. It hasn't done it because the economy is stronger than expected. And inflation is still kind of up, but we expect it to fall. So if you have all these macro forces starting to fall, that's where the real opportunity is in the market. That's where the real opportunity. I think Bitcoin moves the most, or crypto in general, but for sure, once you get yields coming lower, yes, that does signal the economy is starting to weaken. But what happens when economies fall apart? What happens at the bottom of the pandemic when things fell apart? You get the Fed cutting rates. So you might have a negative reaction, but you get the Fed cutting rates, and you get more stimulus. You get more liquidity from the central banks, and so that's the expectation. I think the market is starting to really sniff out, is that the conditions to put risk on the table are starting to improve. Does that make sense?
I'm following you.
What are your questions?
That was heavy level stuff for probably us and a lot of the viewers. So, yeah, that was a lot of stuff. That was deep. Let's see. Let's look. Is anybody, before I go, I want to see if we have any viewers who have questions. Let's see.
I don't know if we have any questions, but traders, for sure, traders like checking out the technicals. That was the first part. We're going to get through this. Just really quick, if you're investing, the S&P is a little overextended, so it broke the resistance levels. I call this the iron level. It broke through that level, and it's overextended. It should pull back. So everybody's getting FOMO right now. I don't know if you heard, a lot of people, hey, I'm going to buy app options on Amazon and Google, and I'm going to buy. And I'm like, bro, you guys better be careful, because you're getting FOMO, and you're seeing the market go up, in the face of this bearish narrative. People are buying option calls. But as soon as everybody's bullish, that's when the market usually rips back. And that's what we're seeing, is that the S&P 500 is a little overextended. Yes, these are technicals. I do technicals. I do technicals all the time. I do it on TikTok or go live. But the technicals are showing us that we're a little overextended. And then also the RSI, this is the relative strength. And that thing is starting to hit the top. And that's where you usually get a pullback at some point. We might go, a little higher, but we'll see. NASDAQ, same thing, overextended, extremely overextended, running into resistance. So we're running into resistance there. And we are actually overbought. We're headed into super overbought territory. And once you get there, there's usually, you could keep going, but a lot of people have probably already the traders have made their money, and you're going to see a pullback at some point. That's just the probability. It doesn't mean it's going to actually happen. Now, the reason why the market probably keeps going higher is because small caps haven't really moved yet. So this is like market breadth, and market breadth is, okay, well, you have FANG going up, you have Apple, Amazon, Google, Facebook, Tesla, you have the big caps going up, and you have other like McDonald's and Walmart. Some of those markets have been moving up for a while. But what about the small caps? What about Palantir? That just ripped 100%. What about there's an IPO that went up like 200% on Friday. So now you're starting to see small caps like, $2 billion, these small cap names starting to move up, because investors are saying, well, shoot, we missed out on the rally. We missed out on Apple all-time highs. We missed out on Microsoft, and we're going to look bad in front of our clients. So we need to start buying beta, and beta is just another word for more risk, higher risk assets. And those usually move the most. So like space, Virgin Galactic, that's going to be in the small cap area. And when it moves, right, to the upside or to the downside. So people are starting to buy that, and there's still room on the RSI for it to go up. So that's why also the market will remain strong. We might see a pullback in NASDAQ and S&P, but the small caps still have a way to actually go. Now, the setup for Bitcoin, next, what about Powell insinuating this is a skip? That is interesting. Powell talked about the skip, meaning they're going to pause rates. Maybe they pause rates, and maybe they skip and they start hiking they start hiking in, so what is it, June? They start hiking in July or August, but they never really, I don't think well, I guess they have done that in the past, but once you pause, excuse me, once you pause, you're typically done. And they could raise rates again, but are they really going to raise rates when we see inflation expectations continuing to fall, especially with the shelter inflation coming down? Are they really going to raise rates when growth is still slowing and you have real estate risks out there on the table and the banking crisis is still going on and the banks are still borrowing money from the bank term funding program, which is basically a loan from the Fed because they're losing liquidity because people are still investing their money. So I think Powell is just managing expectations and trying to keep people from getting too excited. But they're pretty much done. I think they're done hiking rates because inflation keeps making progress. So that's kind of the story here. And now that you have the market breaking out, look at BlackRock. BlackRock, they own $11 trillion in assets. So they're the biggest asset manager. And they are now filing a Bitcoin ETF. We've been waiting for this because the Bitcoin ETF basically means, and there's some speculation to whether they really, filed for a real spot ETF in, real time or a futures ETF or like Grayscale. So there's some speculation there. Either way, BlackRock is like the ESG, like those are the, you've heard of ESG, right?
Right.
Yeah, BlackRock is like one of the main players when it comes to ESG. They lend out money to companies. You have to have these mandates on ESG, whatever. So BlackRock doing it just tells me that they're looking at the Bitcoin bull run, or they're getting ready for Bitcoin to start roaring again. And BlackRock CEO, he's the one, by the way, the CEO, Larry Fink, he's the one who said, I don't see us going into a recession because of the fiscal policy, because of the infrastructure bill, because of the Inflation Reduction Act, and because of the CHIPS Act. He said, I don't think the economy is really going to fall because there's too much stimulus coming in. If anything, inflation might stay a little stickier on the shelter side or on the core services side. So what that means is that they're bullish, and those are the guys who know more than us. They're a little more bullish on the market. They're filing this Bitcoin ETF. And, if it does get through this year, and everybody's been waiting for this since 2020, if the Bitcoin ETF goes through, now you got pension funds, 401ks, all these institutional investors who can now have an avenue or a pipeline to actually get exposure to Bitcoin. That is potentially it's hundreds of billions, potentially trillions of dollars looking forward into the next 3-4 years. So that might restart the bull market, not alone, but the theory is that more people will start filing because like, oh shoot, BlackRock's doing it. Let's do it. Let's file our Bitcoin ETF. So this should be a catalyst to actually move Bitcoin higher. And I say, don't sleep on Bitcoin because everybody thinks in crypto is boring and it's falling apart. That's just not the case. And this is just growth. This is just really, we'll just go through this. Really, growth is still slowing. We're not, this is why inflation is not going higher, because retail sales, reflection of, consumer spending, it's not collapsing into the negative like it did back here in COVID. It is still staying steady. I say it's staying steady. So it's not falling apart, but you want it steady and slow to slow things down, but you just don't want it to collapse. So we're in good territory there. Now, the biggest purchases that are happening month over month are motor vehicles. People are purchasing motor vehicles. That's where all the spending is happening, or the sales in motor vehicles. This is just month over month. But the biggest declines are in gasoline. So gasoline is part of that energy component, that energy inflation. If gasoline is going lower, then that's really good for the economy going forward. People get excited. Like when you see your gas prices spike, that's when it really hits you as a consumer. You're really like worried, like, oh shoot, gas prices are up. What the hell is going on, right? Because you have to pay gas. You're traveling. Most people drive trucks, whatever it is. So that really hits the consumer, and the consumer expectations are starting to increase they're decreasing for inflation, but they're increasing as far as their confidence. Their confidence is actually increasing. So this last chart, we'll get to these last couple charts. This is pretty much the end of the macro report. And what it is showing is, hey, now that we know the Fed is done hiking, they've paused. Maybe they hike again. I doubt it. What is the fastest horse in the race in this macro? What is the fastest horse in the race? And the fastest horse in the race is probably, in my view, it's always been Bitcoin. And what this really shows us here in red is the 4 biggest central banks. So the Fed, the Public Bank of China, the Public Bank of Japan, the BOJ, and the European Central Bank. I believe it's the European Central Bank. So when you add up all those central banks, you see a cycle of their liquidity in red. This is when they unleash liquidity into the markets. So when liquidity goes up, Bitcoin goes up in yellow, right? So you see it's a really clear trend. When liquidity goes up, Bitcoin goes higher. When liquidity starts to drain, Bitcoin falls off a cliff, or it falls, right? It starts to fall. When liquidity bottoms, starts going up, Bitcoin goes higher. It's almost too simple. When liquidity drains, Bitcoin comes lower. At the same time, the dollar does the opposite. When they increase liquidity, right? Well, except for here, this was really tricky because something happened with oil. But as they increase liquidity here, the dollar basically turned over, because to increase liquidity, you're printing more dollars. You're debasing the currency. So when you debase the currency, you're lowering the value of the dollar falls, Bitcoin goes higher. And that's just the trend we've seen. They increase liquidity, the dollar falls, Bitcoin goes higher. So I'm saying, look where we're at right now. We're at the point where liquidity has bottomed. It's basically bottomed. It's starting to pick back up. We see China, we see Japan, the Fed pause rates, the cycle's starting to turn. The dollar is about to roll over. Bitcoin is starting to climb up. So here goes the next big macro cycle. And this is a little clear chart, just looking at Fed liquidity. So just looking at the Federal Reserve. And what you see here is when the Fed increases liquidity in blue, Bitcoin roars higher. When they slow down on the balance sheet, they stop purchasing assets or pumping liquidity into the market. When they slow down, Bitcoin slows down. When they increase liquidity, Bitcoin goes higher. Now, this was an exception. They actually drain liquidity, which we've been seeing for a while. They drain liquidity, but the reason Bitcoin went higher here is because this was the Trump tax cuts. It was fiscal policy. It was fiscal policy, basically the government stimulating. So that was I think it was $1 trillion tax cut. I'm not sure what it was. That moved Bitcoin higher. So you either get monetary stimulus from the government or from the Fed, or you get fiscal liquidity from the government. Now, right now, what we're seeing is that, this is COVID, our post-COVID liquidity went up, Bitcoin went up. So we've been draining liquidity, but now it looks like liquidity is starting to bottom again, and it's starting to pick back up. And if it picks back up, then what do you think is going to happen? Bitcoin's going to start moving higher. At the same time, you get fiscal liquidity, infrastructure bill, CHIPS Act, Inflation Reduction Act. So this is like the perfect setup for crypto to go higher. I know stocks are moving up, but stocks have moved pretty fast. The big risk asset stocks, crypto is still consolidating. Plus, on average, it moves more than the Nasdaq. It moves more. Other than Nvidia tripled pretty quick, Tesla, some of the ones that move fast. Either way, Bitcoin and Ethereum, I'll just stick with those two. Those two explode, 10x. So we should be seeing a big move coming up in Bitcoin. And I know that was a lot of information. This is our first live stream. This is our first YouTube. And if you have any comments, what we can improve on, what we can change, we can do that. Did you have any questions on anything?
I don't have any questions. That was some deep material.
Yeah, that was a lot. That was a lot of information. So we'll try this out. We'll see if we can get some feedback, some better feedback, and improve the information. But end of the story, the closing thoughts are here are that inflation is pretty much done. And those horses, we see the picture of the horses running, that's the market. The market is exploding. It's taking off. Yes, there'll be a pullback, but we're moving higher.